In today's episode, I'm going to get into rate cuts and a property boom. It's an interesting topic because everyone likes to talk about interest rates and what kind of happens, but the three key parts I'm going to get into today are when are rate cuts due, what will happen when rate cuts occur, and then will property boom. Let's get into it. So let's just see when a rate cut's due. Now, these are just the big four banks' cash rate predictions. So pretty much all of them predicted the first cut being around February 2025, which is very soon. And most of them have rates cutting like pretty consistently after that. I haven't included that, but that's kind of where we're at in terms of what they're predicting. What do I think really will they cut rates? Yeah, it's probably most likely around February 2025. The yield curve also states that here. So you'll just see this is just off the ASX rate tracker. So I've gone just back in a little bit of time just so you can see what has kind of happened. Mind you, this tracker has changed quite a bit just over recency. So this was taken a little bit earlier. And the reason I did this is because if you look at the actual interest rates back, or this rate tracker back even in September, it did not look like this. It looked like rates would be higher for longer, and it does change quite quickly, these rate trackers, because the market will determine what happens. So that's what it kind of looked like back then, but you can see alone there, that's a couple interest rate cuts like priced in basically in 2025. What I really think is realistic though, look, there's a couple of things that are going to happen. First of all, international pressure. Second of all, domestic pressure. Both of them are things. So, look, a lot of other actual countries have cut interest rates, and a lot of comparable countries as well. So, I mean, obviously the US, Canada, and the Euro did, months and months ago. But also a couple months ago, the New Zealand actual reserve actually did the same thing, and we're a lot closer, more closely correlated to them. So that also is playing a part. Now, domestically, we have a lot of pressure because of the crappy private jobs market, because of GDP per capita going backwards, because of cost of living. All of that's a bigger issue. Lower inflation's becoming a thing, and as I've mentioned, lower jobs per capita, and the private jobs market I've obviously mentioned as well. So what's the most likely scenario? Look, again, like the big four predicting, I think a February cut's most likely. Look, it may be a little bit later, but it's definitely the most likely scenario for a rate cut, in my opinion. Look, there's a few things that you want to do here though, is look and consider, when rates are high, generally financing is low, but when rates cut, financing is high. So what you just want to look at here is what really happens in the market. So look, you'll see here, this is just between 2012 and 2022, a 10-year period. What has happened with owner-occupier, loan sizes, and you'll see that it's basically completely correlating with the drop in rates. Like the increase in loan size correlates with a drop in rates. So that's very common there, most definitely. What happens to our cities now? Look, when rates are cut and when things change in terms of the cash rate and interest rate changes on our mortgages or refinancing, things happen in different cities. So you'll see here Sydney and Melbourne. So you had higher rates kind of between 2008 and 2011, then lower rates between 2012 and 2022. So you'll see there as well that you kind of had, and I should actually add to that, you had a higher rate also in that kind of dot-com bubble between sort of 2002 and sort of 2008 as well. So you'll see Sydney and Melbourne were actually a little bit more quiet over that period in the higher rate period. Then when rates dropped, you'll see that we had booming kind of property prices. So that's particularly in the late 90s and particularly in sort of the 2012 to 2022 period. However, Brisbane and Perth, almost the complete opposite. You had higher rates kind of in that 2002 to kind of 2008 period in both of them. And then you also had higher rates in sort of that 2022 to 2024 period, which they've both been the top performers for as well. And where Sydney and Melbourne have been a bit quieter since the rates have been higher. So both of these cities kind of they don't correlate with the interest rates the same. Sydney and Melbourne sort of will do the opposite. They'll be quieter, and Brisbane and Perth generally have done better in the high interest rate cycle. That's generally also because in that cycle, generally you have a higher commodities market. That's generally the reason for it as well. What do the numbers say though? Look, in the past 25 years, the cash has been higher than 3% on 15 occasions, and property prices in those 15 years have only fallen on 2 occasions, once between 1% and 3% respectively. They've increased between 1 and 10% on 6 occasions, and they've and basically as well in that time they've increased by more than 10% on 7 occasions. And then there's been 13 property price increases versus 2 falls, right? That's all that's really happened in that period, right? In 15 of those years, right? So yes, you've had, don't get me wrong, in 2008 and 2022 a bit of a correction in the total market. In 2019 you did as well. But if you take most of the proportion of that market, you can see that what's kind of happened here is that the vast majority of the time it's done well. On small occasions it's done poorly, but all it's saying here is you're better to be in the market than sit and wait. That's all that is simply saying. Let's get into the final topic of this episode, and that's just, will property boom? My first answer to that is, in the short term, yes. It will probably do pretty well. And when I say boom, I mean, I don't count a boom as like a boom's really like anything above 7%. It's a pretty good year, because above 7% is literally doubling every 10 years. So that's pretty good in my opinion. So I've just said in the short term, yes, in some cities. Look, for those that really want to know where I'm talking about, really it's probably your Perth, your Brisbane, your Sunny Coast and Gold Coast. Look, Adelaide might, but it's in at the very end of its like, should I say, growth cycle. So that's the areas that might do quite well. Like you may hit, it in somewhere like Newcastle and maybe Geelong, but it's probably more unlikely. But in those other cities, you're probably more likely to. And the reason for that is because of where we're at in the cycle. So you see right here, I put a previous episode called The Property Clock for Each City. For those that haven't seen it, please go back and watch it. It's a very good episode, and I'll discuss why each of these cities are at where they're at. So you'll see here, basically, all of the cities I've just mentioned are kind of in your boom phase. Adelaide's kind of in your winner's curse phase. But, that's why you'll probably get a boom in these cities. Yes, interest rates will increase it, but there's enough underlying supply and demand, or should I say demand to supply in these cities, and they're still in their boom phase of the cycle. So, you're still going to get that probably for the next year or so, and that interest rates are only just going to throw a bit more fuel on that fire, I think, and continue that growth trend in the market. So look, in the short term, I probably want to just identify your best cities. In short terms, you're under 5 years, where we'll probably do the best. And that is Perth, Brisbane, Far North Queensland, and Bunbury/Busselton. Mind you, again, I've said in previous episodes, I mentioned these areas that they will probably do well, but I would still not buy in 2 out of 4 of these locations. The only 2 I would buy in is Perth and Brisbane, and it's about 20 suburbs in Brisbane and about probably 15 in Perth. And I'll tell you right now, in Perth, it's predominantly the Joondalup region and sort of towards Osborne Park as well. And in Brisbane, it's the inner north and the inner east. That's the only areas I'd buy in those in these cities, because they still have a little bit of growth to go. Most of the other areas have grown too much already, and they are very close to the peak of their market. That's the reason. Let's just also consider longer term cities. Now, this is my favorite areas to buy. And again, if we go back to the property clock, you'll see the reason why I want to buy in these areas. Look, you buy in an area that's done poor over the short term, chances are it's going to do well over the long term. The reason is because of something called efficient market hypothesis. So you'll get people online that say, no, that's not true. I'm telling you right now, they're full of shit. I can look back to, literally the 1890s and sometimes the early 1900s and find areas of all of these cities that have done, 7 to 10% growth for 100 years plus, okay? So what they're talking is absolute nonsense. It's not true. Most of these suburbs over the long term do well, aside from crappy suburbs, and you can find ones that are a bit cheaper that are gentrifying, but it has to have the right fundamentals. So your best long-term investments are number 1, Melbourne, followed by Geelong, Newcastle, Sydney, the Central Coast, and Wollongong. These are the areas you want to buy longer term. don't be fooled by the market and it being colder. Yes, I've said in previous episodes, these won't do as well as Perth, Brisbane, and other areas in the short term, but what we're really buying for is longer term. Now I put an exclamation point though against people on a retirement plan of, let's say, under 5 years. You can invest differently. You can buy in the other cities that I've mentioned and do perfectly well, because it'll provide you a little bit more income, which is always good. No one's ever going to complain about that, are they? So definitely consider that. But that's what's really going to happen when rate cuts price in, and what you really should consider with that as well. So thanks for watching, everyone. Getting to the end of this episode, please subscribe to this channel. And for those that are serious about property investing and getting in the market, reach out below. You can book a private consult there, and you can reach out to me and we can find you something in the market. And hang out for Premier Properties on my website. It's just something, that basically you have a higher return basically than most hedge funds, on the New York Stock Exchange. So I generally look for a total return of 13% and above. And that's simply because in that you have basically a higher proponent of capital growth than you have yield, and the reason you want that is you have a higher internal rate of return, because yield slides down over the long term, which means your total return slides down. But capital growth doesn't slide down, yield does, so you want that to be a high percentage to do well. Most people that buy in buyer's agents will struggle to get a 20-year internal rate of return, of anything above 10%. They will absolutely struggle to get that. I'm looking for literally, immediate 13+% return, and probably an IRR of somewhere between 11 and 12%, ideally something around that if we can get it all right. But that's what we're looking for. But anyway, thanks again for watching. Have a great day, everyone. Cheers.